So, if you've been investing in the stock market, something that's certainly been on your mind recently has been how should you be approaching investing in 2020? There's all kinds of people, analysts, talking heads, YouTubers, your best friend, your uncle, throwing recession fears and bull markets and gold going up and holding cash. They're throwing everything in your face. And you're probably wondering, how can I navigate all of these different things that people are throwing at me, and how should I be approaching my investing in the market in 2020? So that is exactly what we're going to cover in today's video. I'm going to break down what our long-term goals should be in the stock market if you're a value investor, if you're a long-term investor, and then how can we work backwards from those long-term goals in order to know what to do today and how to prepare for 2020 so that we can invest in 2020 and make the maximum returns we can over the very long term. But before we get into that, I just want to bring your attention to something related to the Learn by Example platform and community that I've been running over the past 7 or 8 months. And for those who don't know, Learn by Example is a platform and community that I developed to help a small number of long-term investors who have been investing for a little while and understand the basics of value investing, but are ready to dive deeper into the analysis process to be able to consistently find what I call low-risk, high-return investments. So essentially, there's two components that members get access to, that students get access to. There's the platform side, which is essentially where members get access to new stock analysis reports and 60-minute presentations that come out every 2 weeks. So every 2 weeks, I do a report about 8 to 12 pages on an individual business that I've analyzed, and then I do a 60-minute presentation explaining the processes through that analysis. And the purpose of this is that it is one of the best ways to learn how to actively apply a long-term investing strategy in the market by getting exposed to real-life case studies, real-life examples of stock analysis that come out every 2 weeks. Plus, there's about already 20 hours of content on the platform and 20 different reports on individual companies. This will allow you to learn about what makes different companies different and what are the little intricacies that I look out for when I'm doing my stock analysis. And essentially, along with the platform side is the community side. And essentially, this is where students get access to a private Facebook community of like-minded investors, and I'm also active in that group every single day. So I essentially help people every single day in that group. But the reason why I'm bringing it up today is that we're actually going to be closing enrollment for 2019 until next year. So if you want to get in and join the program, this is your last chance to do it before the program is closed for the next couple of months. So if this is something that might be of interest to you, you can learn more about Learn by Example, get your first report and presentation completely free, and learn about the discount that I'm running for the next 2 weeks. All of that will be down in the description below. But essentially, at the time of recording this, there are 8 spots left for enrollment. You can currently use value as a coupon code to get 25% off, and that's going to be lasting for the next 2 weeks. So in 2 weeks' time, it's going to be closing off, or whether it's 2 weeks or those 8 people join first. Whichever happens first, the program will be closed until 2020. So if this is something you're interested in, learn more about it down there, and get yourself the discount and join up at the lowest price that it will ever be. All right, so with that out of the way, let's talk about investing in 2020. And in order to get started by thinking about how we should approach investing in 2020 and how you should essentially be approaching investing throughout your lifetime, we first need to understand what are our long-term goals. And for some people, they're going to have much shorter-term goals than what I would say is smart when it comes to investing in the stock market. A lot of people are trying to just make money really quickly. They're trying to use it as an income source, the stock market, to just get in and make a bunch of money, make 100% in a couple of months and take it out, and it's all win-win and I can make hundreds of percents per year. And I think that's a mistake, because you cannot consistently make really, really high returns like that by focusing in the short term over the long term. So if you're going to be focusing on the short term, your investments are going to be massively at the mercy of the randomness of the market. The market movements on a day-to-day basis are very, very random. You can even look at many of the greatest businesses of all time. Their stock prices bounce around all the time because It's just a marketplace of buyers and sellers coming together and deciding what they're willing to pay for a business. And even in the biggest, greatest businesses, this can jump around a lot. So if you're going to be focusing in the short term, you're going to have a really hard time dealing with all of that. And for that reason, I just choose to invest over the long term, because by investing over the long term, there is a way that we can predict where a stock price will go. And it's by finding great businesses that are going to perform well in the future. And those great businesses are going to have their bumps along the way. They're going to go up and down, and that's going to be entirely unpredictable. But I am not trying to trade in and out of any of those little bumps. I'm just trying to pick a business that is going to be worth a lot more in the future. And as a result, the stock price will head that direction in the future over the long term. And for most of us who are serious about investing over our lifetimes, whether you're 20 years old, 30 years old, 40, 50, 60, for the most part, people who are watching this video are going to have 2, 3, 4, maybe even more decades of investing ahead of you. You have many, many years, and you want to maximize your return over that entire time. What's the good of making a really high return in the next couple of years if it's at the cost of making the highest return possible over that long period? So that's the first thing, is that our goal should be to make the maximum return over our entire investing horizon, not just in some sort of arbitrary short period, such as in the next year or in the next 5 years. So because we're trying to make the highest return possible over the very long term, over many, many decades, and because we are limited as humans in our ability to research and understand businesses, we are going to need to find a small number of businesses if we're actively investing. We're going to need to find a small number of businesses that we are highly confident will be much more successful in 1, 2, 3 decades down the road. Now, the further out that you go, the more uncertain it becomes, of course. But we can look at least 1 decade, and we can find the small number of businesses that are very likely going to be around over the long term. And this is where we start our analysis. And essentially, the question we're asking here when we're analyzing a business is this a great business? Is it a great business? And my definition of a great business has sort of 3 categories that we need to satisfy. The first one isn't really related to the business. It's kind of more related to us looking at the business. And it's that we need to understand what we're investing in. This is the foundation of every single investment. If you go and analyze a business and you don't understand how the different moving parts of that business work, you don't know where they source their products from, or you don't know how the product goes from scrap metal into a finished product into the customer's hands, if you don't understand that process, then you're not going to be able to have the competence to further analyze the business. This is the most important part. And a lot of people ask me sort of, how do you know when you know enough about a company? And there's no sort of arbitrary point at which I say, aha, I know enough about this business to invest in it. It's kind of like you just develop an understanding over many, many years, and your understanding gets stronger and stronger. And something that I tell a lot of people is that when I start investing in a company, I might put a little bit of money into something if I've been researching it for a couple of months, but I'm not going to be fully confident in that business until I've been researching the business and the industry for many years. And that has been the case with some of my investments in the past. I've started with a small investment after researching the company for 2, 4, or 6 months. And then after I've been researching it for 1 to 2 years, my confidence is a lot higher because I understand a lot more about the industry and what drives it, and what are sort of the common problems that prop up and move the stock price around on a month-to-month basis. The second characteristic of a really great business is that it needs to have a competitive advantage. There needs to be something that gives it a unique advantage over the other businesses in its industry. Some businesses sell the exact same products as another business, and there's no advantage because when you're a customer coming to those 2 businesses, you could easily choose one or the other. There's no driving force that's pulling you towards company A over company B. but we are looking for companies that have that driving force, that force customers. Sometimes it's actually forcing customers, such as a toll moat, where you actually have to go with that company in order to access what's on the other side. One example might be something like Netflix's original content. If you want to access their original content, then you need to buy their subscription. But there's other kinds of moats where it's not a forced transaction. It's just that consumers are compelled to go that direction because the offer is so substantially better in whatever way and whatever form it takes its place, depending on what kind of business it is. And when it comes to working out whether a business has a competitive advantage, there's really a two-step process that I go through. The first is qualitative analysis, which is where we kind of just look at the business, we take our understanding of the business, and we try and figure out from what we know what the advantage in that business might be. So, for example, you could look at the smartphone industry. Maybe this was more relevant about 5 years ago, I guess, but it's still relevant today. But you could have looked at all of the smartphones, and there's a standout one among those smartphones, especially 5 years ago. And it was Apple. It was Apple and the iPhone. It was a standout. It was the best product by a mile. There was no Android phone that wasn't laggy. The user experience of an iPhone crushed every Android phone, and that is not negotiable. It's negotiable today, I would say, but 5 years ago, that was not negotiable. And that is a huge competitive advantage. But that's where I'm just trying to identify it. That's the first step. The second step is that we need to see it backed up in the numbers, because ultimately, if they do have a competitive advantage, if the iPhone is so much better, then it should be attracting more customers, and it should be reflected in their sales, in their earnings per share, in the growth of equity within the company, and in the growth of their cash flows. So we look at those four numbers, and I use my spreadsheet to do this. It's free. Check it out. Link in the description. I use my spreadsheet and I have a look at how the growth of their numbers have been over the past 10 years. And I'm looking for strong and consistent growth as an indication that they have something unique that other businesses in the industry do not. And then the third component of finding a great business is looking at management. And management are the people who are actually sitting in the company and making internal decisions. They're deciding, what kind of iPhone do we launch next year? What kind of marketing do we do? What kind of acquisitions do we make? Do we take on some debt? Do we pay down debt? Do we do share buybacks? Do we pay out some dividends? Do we raise some shares? All of those little internal decisions are made by a management team, a team of directors, a team of executives. And we need to make sure that we trust them to make good decisions over the long term. The way you can kind of think of it is that the sum of their decisions, the total sort of addition of their decisions will be how much cash we get back. If they make a bunch of terrible decisions, we're going to get a smaller amount of cash than if they make really good decisions. So we look at management, the three categories of management very quickly. What I look for their trustworthiness, their integrity. Are they being honest with us in sharing the problems and how they're overcoming them? And are they consistently hitting their internal goals and that sort of thing? And then we need to look at their competence. So I like to look at how effective their investments have been, just looking blatantly at what they've produced compared to what they've invested. And then we need to look at their debt, because I don't like investing in companies that have a lot of debt. Debt is something that can destroy any business. And especially with a greedy management, you can get into a lot of trouble where they're taking on a lot of debt, especially when you have a company that takes on a lot of debt to fuel something like a share buyback. That is really irresponsible, and I don't like to see a lot of debt in a company, so I always look at how management has been managing their debt within the company. But essentially, those three categories that we just went through are our way for determining whether or not the business is great. But that's not enough. You can't just invest in businesses that are great, because ultimately, what we're trying to do as investors is make as much back compared to what we pay. So that means that not only does it have to be a great business that's going to return a lot to us, we need to compare what they're going to return to us to what we're going to pay. So this is where we do what's called intrinsic valuation. And my definition of intrinsic valuation is we're trying to estimate how much cash we can get out of a business and therefore put a price on how much we're willing to pay. So for example, if we calculate that a business can return to us $1,000 per share over the next 10 years, then I might be willing to pay about $200 or $250 per share for that, because I'm looking to 4 to 5 to 6 times my money over the next 10 years. So that would be the ballpark in which I would start to invest. I guess if you were calling the $1,000 the intrinsic value, then I'm looking for a 75% to an 85% discount to intrinsic value. But people have different definitions for intrinsic value. So I just like to think of it as comparing the amount of cash we get back to the price that we're going to pay. And by doing that, we can be confident in what return we're going to make. If you have a really great business that's been growing at 4, 5, 6, 7, maybe 10%, 12% per year for the past 10 years, then we could estimate or we could project into the future, being very conservative, and say that maybe they just grow at 3 or 4%. And if we look at the total amount of cash, if they grow at 3 or 4%, and we can pay and get a substantial return for that, if we can pay a substantial discount for that amount of cash, then even if the business underperforms, we're still going to make an okay return. But if they perform as they have in the past or better than they have in the past, they continue to grow at an exponential rate, then we will make a really high return. So that's why it's kind of considered a low risk, high return investment. The low risk is that they don't perform as we expect and we make a moderate return. And then the upside, the high return, is that if they perform as we expect, if we make a good bet, and maybe we make one good bet out of 5 or 1 out of 10, but remember, the other 9 out of 10 are going to perform okay, and then the one might be incredible. And the result of that is a portfolio that consistently outperforms the market. So really, the investment strategy that I'm taking into 2020 is very, very simple. And it's simple for a reason, because it doesn't need to be complicated. We're just finding really great businesses and then having the patience and the discipline to wait for the price to be right. That's it. It's really, really simple. The hard part is going out and understanding how to apply it. So if you want to learn more about this strategy, of course, I teach it very in-depth in my program, Learn by Example. If you want to learn more, all the links are down in the description below. We're closing enrollment in just a couple of weeks, so get in if you're interested. But if you have any questions, feel free to leave them as a comment down below, and I'll be answering your questions after this video goes live. So thanks everyone for watching, and if you did enjoy it, hit subscribe, hit like, but I'll see you guys in the next video.